Now, last year was an extraordinary year in property when, for many homeowners and investors, the value of their properties went up more than they earned in their everyday regular income. But clearly the market's changing. However, during periods like that, when the property market's booming, everyone's an investment genius. But when times are different as they are now, I think it's really important to listen to those people who've got a perspective, who've lived through and invested through successfully a number of economic cycles. And that's why today I'm having a chat with property researcher John Lindeman, who believes that property values are going to keep rising. Now, I know that's contrary to what some of the big bank economists are suggesting. So it'll be interesting to hear his thoughts. I've read his recent report and he's gone back to 1901 to look at the statistics. I'll leave you a link to that report as well so you can understand that this isn't just somebody thinking about property and telling you what's going to happen, but somebody who's done careful research to see what happens to property values when interest rates rise. So at the end of today's show, I hope you're going to have some more clarity on what's ahead for our property markets. Welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Last year was an extraordinary year in our property markets. Around 98% of locations around Australia recorded rising housing values, with many properties increasing in value by, more than 20%. Now, recently, the Australian Bureau of Statistics said that the value of all Australia's houses skyrocketed to $9.9 trillion in 2021. And that was driven by a record-shattering 23.7% annual rise in property prices. Now, this is the official Australian Bureau of Statistics figures and not just the research houses, but they all tend to align over the long term anyway. But what this means is the collective wealth of homeowners around Australia increased by $2 trillion in just 1 year alone. That's a sum 30% larger than the annual output of this whole Australian economy, Australia's GDP. Now, it's difficult to underestimate the extent to which housing wealth's increased in the last 2 years during our pandemic. Remember, only a couple of years ago, various people were suggesting the property market was going to, the commentators were suggesting the property market was going to drop 10, 15%. But before COVID-19, the Australian Bureau of Statistics valued Australia's residential property at $7.1 trillion. And apparently, according to their figures, it ended up in 2022 with a valuation of $9.1 trillion. To put it another way, the growth in property wealth over the 2 years of our pandemic, the last 2 years, was higher than all the gains over the decade before COVID-19 from 2010 to 2019 combined. But now there's all the messages in the media that the boom is over, that property values are going to drop, that inflation is going to go up. And the same commentators who suggested a couple of years ago, the economists from all the big banks, that our property markets were going to crash, and they were wrong then, are once again suggesting that next year property values are going to drop significantly. And I assume, I think my reading of their assessments are that that's related to rising inflation, rising interest rates, and I guess that must, in their minds, mean mortgage stress. But not everyone agrees. I don't agree, and neither does leading property researcher John Lindeman from Lindeman Reports. Now, he's recently written a great blog on his website, Lindeman Reports, and we've republished it on Property Update, why he believes property prices will keep rising. And I love reading his reports because he's talking from many, many years of perspective as a property researcher and having skin in the game, not just an academic. And that's why I've asked him to come on today to hear his thoughts. So, hello, John.
Hi there, Michael, and hello, everyone. It's great to be here.
Well, John, your report suggested that property values are going to keep rising. Does that mean you don't think interest rates are going to go up?
I think they almost certainly will, and that's made more imperative by the fact of the Ukraine-Russian conflict, because that's sending up the price of oil and wheat and other commodity prices. So I think we're heading for higher inflation. And I think that will lead to higher interest rates as well.
But some people are suggesting, and I believe incorrectly though, but you've got the evidence that higher interest rates are going to cause mortgage stress and the property market's going to crash because of that. What are your thoughts on that?
Well, it seems to make sense, doesn't it, that higher
Yeah.
borrowing costs that they'll reduce buyer demand.
Well, I think the thought is, hey, lower interest rates increased demand and fueled property prices, so the reverse must be true. But that's not necessarily correct, is it?
It isn't. And what I did was I put a lot of research into this because, I mean, you could be a sort of a cynic and say, well, if the bank economists are predicting one thing, it's more likely that the opposite will happen.
Yes, that's a fair comment.
You need to test these things. So I looked at all the data concerning what happened with home loan rates and Australian house prices since 1990. Back in 1990, the interest rate was 13.5%.
Yes, we were both investing then, weren't we?
Yes, and it was it had been a succession of rate falls coinciding with house price growth. But I wanted to see whether there was any sort of connection between rate hikes and house price falls. And I looked at the times, when interest rates have gone up since 1990. They went up 1% in 1994, and in 1999, 2000, they went up another 1.5% in total. And 2005 to 2007, they went up again. And lastly, in 2010-11, there was another 1.5 total rate rise. But there's a number of things that come out of this. One is that house prices did not fall each time these rates went up. They may have gone up faster if the rates hadn't gone up, but they certainly didn't fall. And the other thing is that the Reserve Bank has, after this sort of the effect of the interest rate, which is to try and control inflation, has succeeded. What they've then done is they've reduced the rates back down again. So, rate rises never last for very long anyway. So,
well, maybe we should go back a step and explain that currently interest rates are at stimulatory levels. I mean, they're very, very low. And the purpose of that, the last drop has occurred at the beginning of COVID, but they've been coming down for a while to try and bring inflation up to the Reserve Bank's range of between 2 and 3%, to try and keep Australians in jobs, to try and increase employment, to grease the wheels of industry. But once that starts working, and it hasn't for many years now, almost a decade, interest rates have been falling, then the Reserve Bank is going to increase interest rates to stop the stimulus.
That's right. And so the critical question for property owners and property buyers is, well, what impact is this likely to have on housing prices? So, and there's common, consensus view out there that interest rate rises do affect property prices. So what I looked at was, well, what is the nature of our property market? You see, we've got over 10 million properties out there. But when you look at that, Michael, what you see is that 1/3 of our housing is actually fully owned. There's no mortgage on those properties whatsoever, no debt remaining.
To explain that, that's probably about half of all homeowners, because 1/3 of them are investors. Half of them don't even have a mortgage. And that's people like you and me who've been around long enough to have paid off their homes. And there's others who've got minimal mortgages, isn't there?
Yes. And when you look at that, those people that own a house without any mortgage, they've probably, older family homes. And when they do sell, it'll be to downsize. So they're not going to need, to borrow money ever again to buy a property. But there's another third which is owned purely by investors. And because of negative gearing, it means that they can claim the cost of any interest rate rises against their other income. So it's almost, it's a tax benefit. And the other thing they can do, and that is they can raise the asking rents on their properties to recoup the cost of any interest rate rises. And because we've got an acute rental shortage, it makes it a lot easier for investors to do that. So we're left with about 1/3 of homeowners who have mortgages that are being paid off. But as you've pointed out before, interest rates have been falling, and a lot of people bought these homes years ago when rates were a lot higher than they are now. Their financial situations have improved. They've paid down some of their debt, so they can manage a rise in interest rates. It's not going to motivate them to or force them to sell their homes at all. So now we're left with one little group of home buyers and homeowners, which are first home buyers and first home owners, and that's about 10% of the total market. They're the ones that do get affected by interest rate rises. And I've looked at the effect that has. And if rates go up enough, yes, people do go into mortgage stress, the number of buyers does go down. So there is a risk that prices could fall in sort of recent first home buyer areas, but that's the only part of the market that's really at risk from any property price falls.
Well, mortgage stress is a word a lot of people use, and you've just recently used it. And there's a number of measures of that. One of them is if your mortgage costs cost more than, let's say, a third of your income. But that doesn't mean you're going to default on your mortgages, John, does it?
No, I think when people buy a home, especially first home buyers, it's a sense of, status and security, and they'll do anything they can to hang on to their homes. And you and I lived through a period of really high interest rates when it was 13.5%. And, I was raising chickens and growing vegetables and getting a second job, did anything I could to save that home because it was, a place for family. It was security. People do whatever they need to maintain.
Well, they're going to eat Maggi noodles, aren't they, rather than sell up their home because they've got to move somewhere, and rental accommodation is expensive as well. So with those forecasts of 10%, 13% falls, your charts, which we'll have a link to in the show notes to your great blog about this, have shown that property values have never fallen as much as that overall. Individual markets have, and for short periods of time. But when you look at the Australian housing market, which is what these forecasts are suggesting, the total Australian housing market, it's ludicrous. It's improbable to think it's going to fall 15% because interest rates are going to go up a bit. I think the last thing the Reserve Bank wants is the property market to crash, John. It probably wants that as much as another strain of coronavirus. Exactly.
And they don't increase interest rates to punish homeowners or home buyers. They do it to try and control inflation, which is an ultimate a benefit for us all. But what I also did was, Michael, I looked at the capital city house price changes going right back to 1901.
Yeah, I've got that chart in front of me. Very impressive. You've gone back that far.
It was quite a long project to do that. We would have gone back further if we could, but we found that back in the 1800s, you might buy a house for 2 piglets and a gold nugget or something. You couldn't really measure it. So,
yeah.
But that chart, what it shows is that the times when house prices have actually fallen during the First World War, the Great Depression, the 60s credit squeeze, the recession we had to have back in the 1990s, the GFC, and more recently the APRA restrictions on investor finance, they're the times when housing prices have gone negative. And so the reason they've done that is not because of interest rates, but because people couldn't get housing finance. There wasn't enough money available in the banks to lend. So that's the reason that housing prices fall. It's nothing to do with interest rates as much as it is to do with the availability of housing finance.
Now, there have been credit squeezes. When we were young, there were the depressions that you talked about. More recently, there was APRA that restricted lending. So it'll be in the memory of many people listening to this that around 2017, APRA came in and restricted funding to investors, being a bit concerned about that. And then there were a little bit of concerns about the election coming up and changes to tax. So that's what created the last downturn, didn't it?
Yes, and it actually sent property markets slightly negative for a little while. So that's what happens when we have recessionary type interference in the market or crises. That's when property prices fall.
Well, APRA is sitting on the sidelines watching, but I think it would be happy at the moment seeing that the big two markets, Melbourne and Sydney, have basically been flat in 2022, haven't they? And it's the smaller capital cities, Brisbane and Adelaide in particular, that are still booming along.
I think that's also part of a catch-up where the last big boom we had was pretty much restricted to Sydney and Melbourne. So the other states are coming back and they would have been if they'd grown at the same rate.
Sure. So APRA would be comfortable that, well, I'm making this up, but I would assume they would be comfortable that the big housing markets are slowing down and so therefore debt isn't as big an issue. Now, there's no doubt that some people have bitten off more than they can chew, as you suggested, but in general, that's first home buyers and to an extent investors who are now taking the place of first home buyers in the market. But when you look at that almost $10 trillion worth of our property markets, it's shown that the combined debt against that, all the debt against residential real estate, John, is only around 2 trillion. So the loan to value ratio of Australia's housing markets is somewhere around 20%. Now, that's not a risky situation, is it?
It certainly isn't. And it's the reason why our property markets have always exhibited such stability in the past. And even, the very worst house crisis we've ever had during the Great Depression back in the 30s, housing prices fell overall by about 18%. So to come up with predictions of, double-digit price falls is just ridiculous.
It is illogical, isn't it? Having said this, I see this year being a slower growth. Last year, everything went up in value, and that was an unusual year. Now, I know a lot of people got into the market for the first time, and that was good for them, but they may not have realised that that's not the way the property markets work. You don't get capital growth in all the cities, regional capital cities and regional areas and all the suburbs. It's going to be a more fragmented market this year, I think, moving forward.
It certainly is, and I think the big picture items to look out for is we're going to see a massive increase in the number of people coming to Australia. Lots of refugees coming from, obviously, the Ukraine. I think the government will launch some humanitarian campaign to encourage people to come here. Also from places like Lebanon, Hong Kong, Afghanistan, we're going to see a lot of people, but they're nearly all going to be renters for some time. So rent demand is going to rise more than property prices will, I think, over the next few years.
Well, that's going to happen at a time when already vacancies are at historic lows, particularly for houses. And clearly people were moving from apartments to houses over COVID, especially the inner CBD areas where there was an oversupply. But that seems to be filling up now too.
Indeed. I think we've got a massive rental shortage and we're not building enough new properties now. The developers have sort of gone quiet. Housing costs are increasing, so it's harder for developers to turn a profit. So I think we're heading for an acute rental shortage and quite significant rises in rents as a result.
Now, I think it's probably worthwhile just explaining before we finish off what could cause a housing market crash, because there are still the negative Nellies out there and the property pessimists. And what you're telling me is it's not going to be rising interest rates. And history proves that. It could be if we had a recession and people lost their jobs and couldn't keep their mortgages. But that's not on the cards, is it, John?
I certainly don't think so. I think we're heading more for economic growth, especially with more people coming into the country and creating new jobs and businesses. I think that we're going to see economic expansion rather than contraction. And we've already seen that it's when we get into these periods of recession, and when the banks don't have enough money to lend, that's the real issue. That's when prices do fall. And we're not heading for anything like that at all.
Well, I think also for prices to fall, John, people have got to realise that vendors have to sell their properties urgently, can't hold on, or the banks take them over, and banks don't want to do that. But they've got to do that at a time when there's no one else out there buying properties. That's why the values would fall. So it could happen if unemployment rose and people couldn't pay for their mortgages and new people wouldn't be there waiting to buy. But unemployment is at historically low levels, and for every property coming up for sale at the market, according to CoreLogic, 1.2 properties are being sold. So we're buying more properties than the new ones coming in stock. So that's not likely to crash our property markets, is it?
No, it isn't. I think all the indicators are pointing to continued house price growth. We might see some small falls in those first home buyer areas. We've seen that in the past, but they do recover fairly quickly. And overall, I think if inflation starts to increase, then, of course, house prices will go up as well.
And, of course, the other factor could be if the Reserve Bank does have multiple and rapid-fire interest rate rises, but that's not what they're likely to do. As we've said a couple of times, they don't want the housing market to crash. So it will be measured and interest rates will go up. But we also know that many Australians are well ahead in their mortgage payments, John. They've taken the opportunity of the low interest rate environment to get ahead. So while the economists on the one hand said from the banks, they said property values are going to fall, I was interested to read recently that the CEO of the National Australia Bank came out and said a lot of the National Australia Bank's clients are a couple of years ahead in their mortgage payments. And anyone they've lent money to over the last couple of years, they have already lent it on the basis that they could maintain their repayments if interest rates rose 2% and even more like recently 3%.
That's right. That's the reason there's a buffer rate, which protects people. So they're assessed on the basis that if interest rates were 2 or 3% higher than they actually are, that they could still maintain their repayments. So interest rates would have to go up by more than 2% before, there was general pain in what we call mortgage stress, I think. I don't think that's going to happen. If interest rates do go up, they'll go up very slowly. That's what the Reserve Bank tends to do. And they'll say 25 basis points, and they might do that once or twice, see what happens, wait, and then maybe knock them down again. So, that's what history shows us.
It's very likely that interest rates won't have to rise as high this time round as in previous cycles because of the extra indebtedness. And I think the Reserve Bank's also learned lessons from the past about raising interest rates. So the old textbooks of what neutral interest rates should be and how high interest rates may go up, they probably should be thrown out, shouldn't they?
They should. I think also what the Reserve Bank has learned is that there's a time lag between when interest rates go up and the effect on property prices, because as we know, that's a lagging indicator. What we're looking at now are the prices of properties that sold maybe 2-3 months ago. So what they do is, or what they have done, and I've looked at this very closely, put up rates very, very, sort of subtly, like maybe 25 basis points, and then wait and see what happens, and then maybe do it again or not. So I think it's going to be very gradual. It's going to be something which people can, deal with, and it won't cause the sorts of price falls that these so-called experts are predicting.
Well, John, I know you do a lot of research, and I've seen that just in this one article alone, which we're going to link to, but you do a lot of reports as well. So tell us a little bit about the services you provide for people who are interested in understanding more about this.
Well, of course, we have all these blogs. The one you've mentioned is available on our Lindeman Reports website. So you're welcome to go there and have a read of what I have ascertained about the market and its likely direction. But we also do sell predictive reports. We do reports on where areas are likely to rise in price and also high cash flow. So we always have a report available which shows the best areas around Australia for investors. This gives you a general indication of which suburbs have got the best potential. I always recommend people do more research than that, or use a professional buyer's agent such as yourself, Michael, because there's a lot more to it than just simply buying any property in a suburb that's got growth potential. But they're a great start point.
Okay, well, I'll leave a link to that, but it's lindemanreports.com.au. So I think we should finish off by telling our listeners, don't lose any sleep. Don't be scared by the property pessimists. Property values won't rise as much, but they're not going to crash. The value of your house is not going to fall away.
Exactly right, Michael. And I also would recommend ignore the headlines, because they're going to be full of all of this sort of rubbish. So just rest at night knowing that house prices will continue to rise in future.
Sure, the long-term trend is upwards. We're not suggesting there won't be falls. Not suggesting there won't be flat periods. We've lived through those. We've experienced those. So those people who are saying, oh, these are just optimists, unrealistic. No, that's not the case at all. But the long-term trend is up, and so therefore you've got to have a plan to be able to see the ups and downs. You've got to have a finance strategy to buy yourself time, not just properties to ride the cycle.
That's exactly right.
So thanks a lot for your time and those great insights, John. And I hope it's going to make our listeners just feel a little bit more comfortable. They don't have to panic. I look forward to catching up with you again soon, John.
Thank you, Michael. Thanks, everyone.
In a moment, I'm going to share my popular mindset message with you. But before I do, I just want to clarify a couple of things having had that chat with John Lindeman. And I'm going to leave a link in the show notes to his report because there's some really impressive charts. As he said, one of them going back to 1901, just what's happened to our property markets and what really has affected the ups and downs of the property market and why you shouldn't be scared. But having said that, I'm not suggesting that all properties are going to increase in value. Far from it this year. We already are seeing, as the year's moving on, that some segments of the property market are remaining flat, some are falling. But there's not one Melbourne property market or one Sydney property market. And even though Brisbane's doing really well, there's definitely not one Brisbane property market. So therefore, this is the time, if you want to secure your financial future through property, to be much more strategic. In other words, if you get into this stage of the property cycle, which is late in this cycle because we've already had 20% growth, and you just buy any property, you're likely to be a casualty just like has happened in every other cycle. So in my mind, to secure your financial future, you need more than just a buyer's agent to find you a property. In fact, you need more than just a property strategist. And that's why I suggest you have a chat with my team at Metropole, who offer a 360-degree holistic approach to ensure that you grow, protect and pass on your wealth. But we don't want our clients just to get normal wealth. We want them to get, life-changing wealth. Interestingly, while the average Australian investor only ends up with one or two properties, 92% never get past two properties. A recent audit of Metropole's clients showed that our clients are 7.3 times more likely to own 6 or more properties. So why not get the independent, trusted team at Metropole on your side to come up with a customised solution for your specific needs using our time-tested approach. So we help beginning investors, experienced investors, and sophisticated investors manufacture capital growth by becoming property developers. Go to metropole.com.au and look at our range of services. We're not just property strategists and buyers agents, property managers, but we have wealth advisory, financial planning, business advisory, development, renovations. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I'd like to share with you 6 things successful people only do once. You know, they say there's a definition of insanity, and it's doing the same thing over and over again and expecting different results. If you make a big mistake, have a negative experience, and you return to the same situation hoping to get a different outcome, then you're doomed for failure, aren't you? So much of the drama that people go through in their careers, in their personal life, in their investing is avoidable if they listen to the signs the first time round. Now, not with all things, mind you. I mean, accidents happen, ill health happens. Of course, they can't avoid those. But so much else can be avoided. And yet we see people, sometimes people very close to us, in these emotional roundabouts and dead ends, and they're hoping for a different outcome. So let's look at 6 things successful people only ever do once because they learn not to do them again, and see where you fit in. The first thing is they only trust the wrong people once. I remember reading something from an American writer who once said, when somebody shows you who they are, believe them the first time. Now, there's a message in that. It's a great saying because it touches on what we know to be true. Sometimes we ignore our gut instinct about certain people, and it can get us into hot water. Pay attention to those who you work with, who work for you, and if they don't add anything to your life or your business, but in particular if they cause chaos and problems, don't excuse it. Don't excuse their behaviour. The second thing successful only do once and then they learn is mishandling money. Becoming good at handling money through saving, through investing, through getting involved in real estate, through projecting forward. It's a skill. It actually is. It can be learned, and that's why I spend time teaching you how to do it. And of course, we all make mistakes along the way, but smart people take money seriously. They pay attention to it. Again, it doesn't mean they get everything right, but it does mean that whenever they're careless with it, they learn. They never say, oh, it doesn't matter. The third thing they only do once is to forget about the long-term reward. On the road to success, sometimes it's easy to forget, and occasionally you need to make some tough decisions and go without something in the short term for the benefit of the long term. Interestingly, this is a theme that comes up a lot, isn't it, as we have a chat, and it's the concept of delayed gratification. If you make decisions based on what you may think feels good in the moment, then it's very likely you're going to fail to take care of your long-term plans. Maybe you say yes to something just to keep the peace, but it's not the right path. Don't do that. It can really throw a spanner in the works. Another thing that successful people only do once, because they've learned, is to ignore their values. Look, all of us have got an innate sense of what's right and what's wrong. We've also got boundaries on what's acceptable behaviour, on what we will and what we won't agree to. Successful people don't ignore this internal value system. They know, maybe even from making this sort of mistake once or twice, they know the high personal price that's paid when you go against your own values. Something else successful people only do once, because they've learned, is they don't badmouth others. You may be in competition with somebody you dislike. You may even have a very good reason for disliking them. But successful people don't badmouth others in business, in life. They know it looks petty, and it's a sign of poor character. It also shows that rather than focusing on the work at hand, they're focusing on trashing others' reputation. Now, that's not a good look. And the other thing successful people only do once is ignore the detail. It's so important to check the detail and analyse the deal, ask questions, check the fine print. A healthy skepticism is just that, healthy and wise. If it's too good to be true, it probably is. So it's really important not to put your head in the sand. If you're not strong on detail, you better surround yourself with people who are. So the bottom line for today's mindset message is sometimes half the struggle of being successful is acting it. If you pay attention to your gut, to your intuition, if you don't badmouth others, if you're rigorous with detail, if you trust your instinct, if you surround yourself with the right people, you're going to be well on the way to success. Well, I hope my chat with John Lindeman today gave you some comfort about what's ahead for our property markets. And if you learned something from it and you know somebody else who'd get benefit listening to my chat with John, why not tell them about the Michael Yardney podcast? In fact, I'd really appreciate it, because my aim is to help as many people become financially fluent as possible, and I'd like you to help me in that aim. So just tell them about the Michael Yardney podcast, or there's a share button on all podcast apps anyway. Just tell them about it, or tell the world by leaving a review. Now, you can catch me in between these podcasts by following me on social media. Just look for Michael Yardney, and you can join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group, where you'll be able to get something new from me every day, some charts, some tips that I don't leave elsewhere. And I've got a way of saying thank you to you for listening to this podcast. Go to podcastbonus.com.au and you can download a heap of free ebooks and reports. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?